Hi everyone, so finally after a lot of pondering and mulling over, I decided to talk about my own portfolio. A couple of subscribers asked me about this many times in the past, and in particular a good one called Zero has been asking me for a while now. So Zero, if you're listening, I haven't forgotten about you. So here you go. This is my $197,493 stock portfolio. If you know me, and I hope that some of you does by now, you know how crazy I am for Excel and Google Sheets. So of course, paranoid as I am, I checked every detail and stats of my portfolio movements in a Google file that I created. I want to jump straight to the single position, but before that, from the dashboard, I can show you a couple of interesting graphs that are going to give you a first overview of how my portfolio is composed. Let's start from this breakdown ETF stocks. And as you can see, as of today, I got almost a perfect 60-40% between ETFs and stocks. It's not a coincidence. I've rebalanced the portfolio around 2 weeks ago and sold tons of stocks. And I also like round, beautiful, tidy numbers, being the paranoid and obsessed engineer that I am. In reality, I'm still way too invested in stocks in my opinion, and I'm planning to get to 80-20% within a year. Basically, I'm planning from now on to buy only ETFs, except if another big crash comes and stocks are again on sale. But the reason why I have so much in single stocks is that when I started investing, inexperienced as I was, of course, I went all in on stocks with everything I had. And on crypto, but this is another story. Thing is, it didn't go so bad because I invested most of the money in big tech companies, which really didn't go bad lately. Now, coming down to the sector breakdown of my portfolio, this shows you how much I'm investing in sectors within the individual stocks next to the 61.5% in ETF. Right now, I got 12% information technology, so companies like Apple or Microsoft, 9.3% on consumer discretionary, companies like Amazon or Tesla, 7.2% consumer staples, Coca-Cola or PepsiCo, 3.6% communication services like Meta or Google, 3.2% energy like Exxon or Chevron, and 1.6% respectively for financials and healthcare. I don't have single stocks in utilities, industrials or real estate, although I used to own REITs in the past and even some industrials, but I sold everything now. The last graph I want to show you is an overview of the performance of the single stocks and ETFs of my portfolio. I'm not doing this to brag, but merely to tell you that everything that you see on the left side with positive returns are stocks and ETFs that I bought over the years, while on the right side are the stocks that I bought like more recently. What I want to say with this is that if you choose your stocks or ETFs well, in the short term you might still make some losses, but in the long term the stock market is not a traitor. It's gonna pay you back if you did your homework. Alright, but let's get now to the most important part of the video and let's disclose my positions. I'm gonna move up now from the stocks or ETFs with the smallest weight on my portfolio up to the ones with the highest weight. So I have exactly 40 positions between ETFs and stocks, so I'm gonna have to quickly mention all of them and focus more in detail only on the ones that you might know less. By the way, I always talk about dollars because usually euros and dollars are almost on a 1-to-1 ratio. But actually right now, 1 euro equals $1.09. So to be honest, my portfolio in dollars is a little bit higher than in the video title. Before starting with the list, please consider that I'm not a financial advisor, so you need to absolutely assume that all my investment decisions are wrong. Don't follow me. Ever. But follow my channel by subscribing, which instead is a great thing to do so that you can see how my portfolio develops in the future and get investment content from the Italian Ginobili. Alright, let's move on now to the first stock, which takes 0.1% of my portfolio, or to be precise, $156. The first stock is a new electric vehicle manufacturer called XPENG, ticker XPEV, which is a Chinese company founded in 2017. This company got my interest first of all because they have increased their sales a lot since 2018, going from 1 million to 3.4 billion. Net income and free cash flow still look extremely bad, but that's always like this for new companies because to launch their brand, they have to invest much more than what they sell. Another reason is that they are the first company to roll out self-driving technology in Beijing, and this just happened like 2 weeks ago. So far, I'm sitting at plus 25.8% and I can't really complain. The second stock takes 0.2% of my portfolio, around $315, and it's Meituan, ticker MPNGF. Again, a Chinese company. Meituan is one of the largest platforms in China, and it's basically a food delivery platform like Seamless or DoorDash. They increased their revenue constantly since 2015, and now they finally have a positive net income as well as a positive free cash flow after running negative numbers in the past due to heavy expansion. Like every Chinese stock, since 2021, Meituan is down 70%, and in my portfolio I'm down 21.1% with it. Still, it's a solid company, and by the way, not really a small one. In fact, it's the third largest company in China per market capitalization after Tencent Holdings and Alibaba. Alright, the next company takes also 0.2% with $444 and is again a Chinese company, but this time a biologics drug development company called WuXi Biologics, ticker WXXWY. They recently increased manufacturing capacity in Germany, and they've had really sound numbers in the last 10 years with constantly increasing revenue, net income, and earnings per share. Go to their balance sheets and you'll find a ridiculously low long-term debt compared to their assets, which is always a good thing, a high shareholders' equity, and the free cash flow is also finally moving into positive numbers soon. I'm down 22% with this stock, but as you know, that's the trend with Chinese companies now. The next company I have covers 0.3% of my portfolio, and it's Zoom, ticker ZM, which you should know as one of the most famous video communication companies in the world. Between the COVID pandemic and the crisis of 2021, Zoom was having a huge growth, which was mostly driven by the fact that everyone was working from home. But since January 2021, it's been going down a lot and lost now over 90% from its peak. Katie Hood from ARK Investor has always been bullish about it, and she bought again $17.5 million in Zoom stocks around a month ago. In my portfolio, Zoom is sitting at plus 3.7%. But don't let it fool you, I actually lost quite a bit of money on it selling shares in the past, and now I'm left with the breadcrumbs. The next company is ServiceNow, ticker Now, that covers 0.3% of my portfolio and is sitting at a really nice 43.1% gain in my portfolio. ServiceNow is an American software company from California that offers a cloud computing platform for company workflows. After that, I have a Dutch company, by the way, one of the few European stocks that I possess, and it's called ADYEN. At least I think you pronounce it like that. ADYEN is a Dutch payment company that business can use to accept e-commerce and mobile payments. What attracted me from ADYEN were the really solid financial data with growing revenue, net income, earnings per share, and good return on equity and invested capital. Revenue grew 50% since 2021, and at the same time, stock price went down 40%. So I believe that this is a good price point. As of today, I'm at plus 27.3% gain with this, which is not bad considering that I got this in a relatively short period of time. Now, the next one is called CrowdStrike Holdings, ticker CRWD. Here I literally bought at the bottom, hopefully, and I'm sitting at plus 52.4% gain with a total value of $870 or 0.4% of the portfolio. To keep it short, I chose to buy CrowdStrike Holdings because they have growing revenue, net income, and above all, a wonderful free cash flow growth since the beginning. And I ran a discounted cash flow analysis when I bought it at the beginning of 2023, and I knew that it was trading at a lower value than its intrinsic value. Next is a company called Salesforce, ticker CRM, that probably most of you know. I'm at plus 22.5% gain here with around $1,000 invested. So what does Salesforce do? Salesforce is a cloud-based software company based in San Francisco, which is focused on sales, automation, and e-commerce. As for many other companies for which I have a small percentage like these ones, I bought them this year to take advantage of the discounted price. The next company sells a drink that probably all of you like. I'm talking about Coca-Cola, ticker KO, and I have around $1,135 of it with 37.4% gain. Not much to say about this, a good company that Buffett loves and that pays good regular dividends. After Coca-Cola, I got again a Chinese electrical vehicle manufacturer, and this time it's NIO with $1,200 or 0.6% and a loss of 12.8% so far. Chinese companies. Now, the problem with NIO is that it's not as strong and established as BYD in China, and lately it had to show earning losses and weaker sales, for which they stated that they're going to be lowering prices for their models. This is partly due to a price war that has been going on in China between Tesla and Chinese companies. The next company I have is unfortunately 42.9% down, and is Alibaba. Probably all of you know it, the giant e-commerce website from China that most sellers all over the world use to source products that they then sell on Amazon FBA. Alibaba is down over 60% since 2021, and the reason it crashed like this is that they have been fined and hit by the Chinese regulators for violations of the country anti-monopoly laws, and a couple of other reasons. Now, I can't believe that the second largest company in China is not going to be able to resuscitate from this, so I'm going to keep my stake even though it does hurt a lot. Alright, now, next company is Tesla, ticker TSLA. Here I am at 51.9% plus with it, and it covers around 0.7% of my stock portfolio. There is no need for presentations here, everybody knows Tesla, and I'm bullish for the long term. so I'm happy to have it in my portfolio. 0.9% or $1,838 is my stake in Adobe, ticker ADBE. You should know the company Adobe from Photoshop, Premiere, and the whole editing program suite. I got interested in Adobe a couple of years ago, first of all because I use its softwares, and when I made a discounted cash flow calculation on it, I found out that it was actually trading at an incredible price compared to its intrinsic value. And I bought a lot of it, but it was like 1 or 2 years ago. Moreover, there are thousands of reasons to own this company, like they have a 27% net margin, growing earnings per share, and decreasing PE ratio, healthy debt ratios. Nevertheless, I haven't calculated the intrinsic value now, and I can't say if the stock is overvalued right now or not. I'm sitting at 107.7% gain with Adobe, which is sweet, and year to date it grew 47.96%. 1% of my portfolio is Tencent Holdings, which is the biggest Chinese company by market capitalization with $438.83 billion. Then I have 1.1% of Meta with 36.7% gain, which would have been much more, but unfortunately, I made the mistake of selling a lot of it last year. Anyway, then I have Chevron Corporation, one of the biggest oil and gas companies, for which I have around $2,300 with a 1.2% portion of the portfolio. And Shopify that I bought at a really good moment after the crash, and it's given me so far a 101.3% gain, and for which I have almost $2,400. The next one is an ETF that covers the Asian market. In Europe, it's called iShares MSCI EM Asia US ITS ETF. And in the US, there is a version that is not identical, but almost. And it's the iShares MSCI Emerging Markets Asia ETF. For this, the US ETF unfortunately has a quite high expense ratio of 0.49%, while the European ETF only 0.20%. It has 642 companies, and the country exposure covers all Asia, with an overweight in China with 31.88%. Followed by Taiwan, India, and South Korea. I have Nvidia, ticker NVDA, with 1.4% weight on my portfolio and 237% total gain since I bought it. And I have AbbVie, which is a pharmaceutical company that I talked about also in past videos and gained 110.2% so far. Following AbbVie, I've got my first sector ETF, and this is the S&P 500 Consumer Staples ETF from iShares. This covers 1.5% of my portfolio, and so far I'm down 1.3% because I bought it this year and the consumer staples sector slowed down in 2023. If you come from the US and want to invest in the consumer staples sector, you could go for VDC, the Vanguard Consumer Staples ETF. Going further up the stairs, BYD company with ticker BYDDY weights 1.6% in my portfolio with around $3,000. And this is a Chinese company that all electrical lovers should have in their portfolio. Still, I'm not telling you to necessarily buy it now because you might see some price decrease in the next months. The company has grown incredibly since 2020, both in terms of stock price and numbers. In fact, only in 2022, the revenue doubled compared to 1 year before. And all of this keeping a neat, growing, positive net income and free cash flow in the last 10 years. The next company stock that I possess is Bank of America with 1.6% of the portfolio or around $3,200. I'm gonna be brutally honest with you. I bought Bank of America in 2020 simply because Warren Buffett had it. I'm not a financial advisor, I told you, I think it's clear now. Then I have AMD, Advanced Micro Devices, ticker AMD, with $3,300 and 1.7% of the portfolio, and a growth of 76.7% so far. AMD is a direct competitor of Nvidia, and if you have to choose, Nvidia is a stronger choice. And in the last decade, it grew immensely more than AMD, as you can see here. Unfortunately, it's also extremely priced, and if you hadn't panicked in 2022 when you lost 66% of value, buying in October 2022, you'd have enjoyed now a 345% growth within less than a year. So should you buy Nvidia right now? A great company, but it's not trading at a discount right now. All right, let's move on to the next position that takes 1.7% of my portfolio and is the iShares MSCI China UCITS ETF, ticker ICHN. I'm bullish on China in the long term. Now it's clear to you probably, and that's why so far you've seen so many Chinese stocks in my portfolio. Now you need to be careful about this ETF if you want to buy it, because there is another ETF with the same name that has a completely different holdings composition. So if you look for it, make sure that the first holdings are Tencent, Alibaba, Meituan, and so on, and don't confuse it with the other iShares MSCI China A UCITS ETF, ticker 36BZ or CNYA, because otherwise you're going to get a bunch of companies that you're not gonna know. So I'm gonna disclose my next and last 9 individual stocks quickly because they're all famous companies that everybody knows. Home Depot, ticker HD, with 1.8% weight in my portfolio and a growth so far of 93.5%. ExxonMobil, my second energy company next to Chevron, weighs 2% of my portfolio with around $3,900. And lately, I've been evaluating if I should also buy some Occidental Petroleum, ticker XPEV, that trades at a better price and is in Buffett's portfolio. PepsiCo, great dividend company with a current dividend yield of 2.72% with 58.6% gain, 3.70% year to date, and a weight of 2.1% in my portfolio. Procter & Gamble and Johnson & Johnson follow with 2.2 and 2.3% of my portfolio respectively, and these two are incredible consumer staples companies that both paid and increased dividends for over 60 years. So if you're a dividend investor, these two companies should never miss in your portfolio. Then we got the good old Google with Alphabet. This takes 2.3% of my portfolio and grew 38.6% year to date. Follows Amazon, that I bought unfortunately before the crash, but then again after, and this helped me have a total gain within my portfolio of 28.4%. But if you were clever enough, had enough cash and bought it a lot this year, you would have enjoyed better the 46% year-to-date growth. Then we've got the two tech companies that don't require any presentation. I'm talking about Microsoft and Apple, which really are companies you cannot not like. Really, if you don't own Apple and Microsoft, I'm sorry for you. Year to date, they grew 44.7 and 47.9% respectively, which is wonderful. And in my portfolio, they have a total gain of 126.7% and 163.5%. All right, now we're finally getting to the last and biggest part of my portfolio, which is only composed of ETFs. I'm gonna tell you straight away that unfortunately, I own neither ACHD nor QQQ. I love both ETFs, I follow them, I study them, I keep track of them, but I can't have them because I'm investing from Europe. Baby, when are we gonna move? Anyway, the first ETF here is an ETF that I originally bought actually to invest part of my emergency savings because it's extremely stable. I'm talking about the iShares Edge MSCI World Minimum Volatility with ticker IQQ0. If you're investing from the US, the closest alternative, which is almost the same, is the iShares MSCI Global Minimum Volatility Factor ETF with ticker ACWV. 3.2% of my portfolio is in this, or around $6,300, and you have to imagine that not only this ETF is quite safe because it covers the whole world, but it's focused on companies that tend to be extremely stable and mature, like Cisco Systems, PepsiCo, Johnson & Johnson, pharmaceutical companies from all over the world, and so on. The next ETF is the S&P 500 of the consumer discretionary sector. And for this, in Europe, I had to buy the iShares S&P 500 consumer discretionary ETF with ticker QDVK. In case you invest from the US, I suggest you the Vanguard Consumer Discretionary ETF with ticker VCR. They're basically identical except for some differences in percentages, and with this you're gonna get over 300 companies such as Amazon, Tesla, Home Depot, McDonald's, Nike, with a really low expense ratio of 0.10% for the American ETF and 0.15% for the European version. The reason why I chose to own a consumer discretionary ETF is that if you check the growth of all the different sectors in the last 10 years, you see that information technology and consumer discretionary are the two sectors with the highest growth, with 191.57% and 511.22% respectively. In fact, let me jump directly to the third heaviest ETF in my portfolio, and you'll see that I have here the iShares S&P 500 Information Technology ETF with ticker QDV. There is a reason why for now I'm skipping one ETF on my list, but you'll understand later. Anyway, if you invest from the US, instead of the iShares, I would suggest you the Vanguard Information Technology ETF with ticker VGT. If instead you want an ETF that not only encompasses information technology, but the whole growth sector, your best choice is, without the shadow of a doubt, the Invesco QQQ ETF, which had a similar tremendously high growth to the Vanguard ETF, but at the same time gives you access to all great growth companies in all the other sectors. Now, in second position, I have an ETF that encompasses the whole world, and that is the Lixor Core MSCI World ETF from Amundi, with around 12.5% of my total portfolio. If you invest from Europe, you basically have two main choices. One is this, Amundi Lixor, and one is the iShares version. They're basically the same, but the Lixor has an expense ratio of 0.12%, while the iShares 0.20%. If instead you invest from the US, you can choose the Vanguard Total World Stock ETF with ticker VT. Now, the World ETF is basically your safety net if you're unsure how the American economy is going to develop in the long term. And I think that Although American companies are now so global that we can't really talk about American economy, still it's a good idea to cover some bases in other developing countries. Alright, now we finally got to the first position, which if you know me or something about investing, you know is one of the best or maybe the best ETF category in the world. I'm talking about the glorious S&P 500, which you have to love if you love finance. And for this, I own the Vanguard S&P 500 ETF with 25.3% of my portfolio. If you invest from Europe, you're gonna find it under the ticker VUAA, and from the US, it's VO. Now, I know that I'm extremely heavy on the American stock market with the stocks and also with the ETFs that I possess, but I'm planning in the future to move more and more towards the world and emerging markets if I see that they start growing faster than the American market. The reason why I hid from you my ETF number 4 is simply because it's a duplicate of my first one, and it's the iShares S&P 500 ETF. So why do I have it? Because Vanguard ETFs have become available in Europe only in the last 2 years. So until a while ago, it was my only choice. Alright, this was the overview of my portfolio. As you can see, I'm investing more and more into ETFs because you can see it from here, of course, but I made a lot of mistakes with individual stocks in the past, and ETFs instead are always a safe option for the long term. Let me know in the comment section below what you think about my portfolio, and the most important thing is subscribe to my channel and click the ring bell to get new videos about finance and investing every week from your Italian Ginobili. If you missed it, check my last video about the comparison VOO versus QQQ, or if you're interested in SCHD, I got a couple of nice videos like this one. Alright, I wish you a great day everyone, and as always, I'll see you in the next video. Ciao!